Supermicro just delivered a massive AI earnings report, with revenue surging 122% as the market falls back into full AI euphoria. But the most dangerous moment in any market is when everyone starts believing AI stocks can only keep going up, because hidden inside this earnings report are several signals that are causing more and more institutions to reassess the entire AI sector. Hey everyone, on Deep Dive Stock Earnings. Here, we don't just look at price moves, we break down the logic and trends behind them. If you want to truly understand how the market works, make sure to like and subscribe. Let's get right into it. Let's start with the core numbers. Supermicro just delivered one of the most closely watched earnings reports in the AI sector. According to the company's official results, quarterly revenue hit a record-breaking $10.2 billion, up an incredible 122% year-over-year. And after adjusting for the company's recent 10-for-1 stock split, non-GAAP diluted earnings per share, the EPS number investors care about most, came in at $0.84. That's not only dramatically higher than the $0.31 reported a year ago, but it also clearly beat most Wall Street expectations. For a company already operating at this scale, maintaining this kind of growth tells you that AI infrastructure demand is still expanding at a very aggressive pace. Generating over $10 billion in quarterly revenue means Supermicro has officially entered hypergrowth territory. Most traditional hardware companies need years just to double revenue once, but Supermicro is still growing at an extraordinary pace, even at massive scale. That tells you the global race for compute power is far from over. At this point, the market is no longer just betting on AI as a concept, it's betting on which companies can consistently deliver the infrastructure powering the entire AI ecosystem. But it's not just the current results that impressed investors. Supermicro's outlook for the next several quarters was equally aggressive. During the company's earnings call, management projected next quarter revenue between $11 billion and $12.5 billion. At the same time, the company raised full-year revenue guidance to a range of $38.9 billion to $40.4 billion. That guidance increase sends a very important message to the market. Demand for AI servers remains extremely strong, and order visibility continues extending further out. In other words, the massive AI data center spending cycle among major tech companies is not slowing down the way many investors previously feared. This guidance directly pushes back against the growing narrative that the AI investment cycle may already be peaking. As long as companies like Microsoft, Meta, Google, and Amazon continue aggressively building AI infrastructure, the AI server supply chain still has a very powerful growth story behind it. A lot of people keep talking about an AI bubble, but if you look at real capital spending trends, the AI infrastructure build-out is still operating at historically elevated levels. But beyond revenue growth, the biggest surprise in this report may have been margins. For a long time, weak profitability was one of the biggest concerns surrounding Supermicro. Many investors worried the company could fall back into the low-margin competitive environment typical of the traditional server industry. But this quarter, non-GAAP gross margin rebounded to 10.1%. That's higher than the 9.7% reported a year ago. It's also a major improvement from the previous quarter's 6.3%. This suggests the profitability pressure created by rapid expansion may finally be starting to ease. At the same time, higher value products continue making up a larger percentage of sales. And honestly, margins are what serious investors are watching most closely, because improving margins suggest Supermicro may finally be moving beyond simply winning business through aggressive pricing. Higher margin products are beginning to contribute more meaningfully, while the company appears to be regaining pricing power with customers. That's one of the biggest reasons the market has started rotating the stock again. And behind this margin recovery is one critical technology trend: liquid cooling. As power consumption continues rising with next-generation chips like NVIDIA Blackwell H200 and AMD MI300, traditional air cooling systems are becoming increasingly inadequate for modern AI data centers. One of Supermicro's biggest competitive advantages is that the company invested heavily in direct liquid cooling, or DLC, years before many competitors. Today, it already has integrated in-house design, manufacturing, and large-scale production capabilities. For modern AI infrastructure, liquid cooling is no longer just an optional upgrade. It's quickly becoming a critical requirement. And this may be Supermicro's most important moat right now, because the next phase of AI infrastructure competition may no longer be just about bits themselves. It's about who can solve power efficiency, thermal management, and deployment speed. NVIDIA's latest Blackwell chips are incredibly powerful, but they also place far greater demands on cooling and electrical systems than previous generations. Without advanced liquid cooling, a lot of those high-performance chips can't fully operate at scale. But behind this technological advantage is also a major business model transformation. During the earnings call, CEO Charles Liang repeatedly emphasized that Supermicro is evolving from a traditional server manufacturer into a full-scale data-centered infrastructure provider. In the past, the company mainly sold standalone servers and hardware components. Today, it's delivering integrated rack-scale solutions that combine bus, liquid cooling, networking, and software systems into one unified platform. In other words, Supermicro is no longer just selling hardware. It's selling complete AI infrastructure systems that customers can deploy immediately. And honestly, this business model shift may be the real reason revenue growth has gone parabolic. Customers no longer want to spend months assembling infrastructure themselves. They want turnkey AI systems that can be deployed immediately and start training models right away. That shift significantly increases the overall value Supermicro can capture from each customer relationship because the company is no longer competing only on hardware pricing. It's participating in the entire AI infrastructure stack. But despite all the bullish momentum, the market is becoming increasingly focused on one major issue: cash flow. According to the earnings report, Supermicro posted a massive $6 billion operating cash outflow this quarter as the company aggressively purchased NVIDIA chips to support surging customer demand. And that number has quickly become one of the biggest points of concern on Wall Street, because it means the company is using enormous amounts of capital to sustain its current expansion pace. If industry demand slows, supply chains tighten, or customer purchasing patterns change, this highly aggressive expansion model could eventually face serious financial pressure. In other words, the faster Supermicro expands, the more sensitive the business may become to any slowdown across the AI infrastructure cycle. And this is really the biggest risk surrounding the company right now. The more orders Supermicro receives, the more upfront capital it needs to secure inventory and support production. So investors are no longer just evaluating growth rates. They're evaluating whether this expansion model is truly sustainable over time. If demand eventually slows, cash flow pressure could become a much bigger issue very quickly. And those cash flow concerns are exactly why bearish analysts remain cautious on the stock. Some firms argue that even after margins recovered to 10–1%, profitability is still relatively thin compared to the highest margin companies inside the AI ecosystem. If component costs rise again, or if legacy server giants like Dell and HP become more aggressive on pricing, Supermicro's margins could come under significant pressure. And that's one of the biggest reasons Wall Street remains divided on the company's long-term profitability outlook. A 10% gross margin still tells you Supermicro fundamentally operates a hardware integration and systems delivery business. It doesn't enjoy the kind of ultra-high margin software and chip economics companies like NVIDIA benefit from. So if industry competition intensifies, profitability could absolutely face pressure going forward. Some investors see Supermicro as one of the biggest winners of the AI infrastructure era, while others still see it as a high-growth company carrying very high execution risk. But despite all the skepticism, bulls continue pointing to one major advantage: speed. Thanks to its modular architecture approach, Supermicro can typically validate and deploy new AI systems far faster than competitors whenever NVIDIA, AMD, or Intel launches new chips. And that speed advantage is becoming increasingly valuable in today's AI race, because the companies that can deploy servers faster are often the ones that gain the earliest advantage in training next-generation AI models. In the AI era, speed is everything. Whoever deploys servers faster gets the first shot at training the next generation of AI models. So the real question is, after Blackwell liquid-cooled racks ramp at full scale, can Supermicro keep handling the cash flow pressure and still sustain its next phase of growth? What do you think? Would you still stay bullish on Supermicro, or is it time to be more cautious? Let me know in the comments. Like and subscribe to Deep Dive Stock Earnings, and I'll see you in the next one.